This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 278, and this week, Ben, we have a great conversation with a professor who will certainly appeal to the more nerdy of our listeners, which I know there are many. So this week
But it's I don't mean to interrupt you, but it's both. Like
true.
The back half of this episode will satisfy the geekiest of geeks, but the first half or whatever it was I don't think was just for geeks. I think it was broadly.
No, that's fair. That is fair. Anyways, we were joined by Juhani Linnainmaa, who is a professor of finance at Tuck School of Business at Dartmouth College, where he studies asset pricing, investments, and household finance. Before joining Tuck, he was a faculty member at the University of Chicago's Booth School of Business. He is also a research associate at the National Bureau of Economic and has won many awards for his research. He holds a PhD in management from UCLA Anderson School of Management and an MSc and BA in economics from Helsinki School of Economics. So with that, Ben, give the backstory and cue this up.
I mean, listen, this is another case of a guest that I kind of always knew we had to have on the podcast because his research is just incredible.
Yeah.
And I had referenced it so many times in my YouTube videos and in past deep dives on this podcast as well. And I don't know, so it was like an inevitable episode. And so I finally reached out to Juhani, and he was more than happy to come on the podcast, which we appreciate very much. And I think it was an awesome conversation. We talked about, he's got this big body of research on financial advisors, and people will be familiar with the big paper, The Misguided Beliefs of Financial Advisors, which I've been referencing since before it was even published. But he's got more on advisor fixed effects, which is basically like an advisor's own portfolio has a bigger impact on the portfolios of their clients than the characteristics of the clients themselves.
So interesting.
Fascinating. So it's like if an advisor has a home bias in their own portfolio, their clients are more likely to have a home bias, even if there are other reasons that their clients shouldn't have a home bias. And likewise for equity, if they're like an equity heavy advisor, their clients are more likely to be equity heavy, even if based on whatever lifecycle model or something, they would you would expect them to have more fixed income. And if you switch advisors, like if you switch from a fixed income heavy advisor to an equity heavy advisor, the portfolio becomes more equity heavy, which suggests that it's not clients choosing advisors that meet their portfolio needs, but it's the advisor fixed effects that are explained. Anyway, I'm giving away the whole episode.
I was going to say you're spilling the candy here in the lobby.
It's just so interesting. And then we also covered the effect. So advisors are not doing portfolio customization much, and they often have misguided beliefs. So like why do people use them? And there are a couple of really interesting papers that they've done, that Juhani's done, using regulatory changes to look at how advisors influence clients' portfolios. So just fascinating. And then at the end, we talk about the cross-section of returns, which I'm sure that's the part that the geeks are gonna. That's more than enough for an introduction, though. Juhani is also the co-director of research at Keepos Capital, which is a systematic macro hedge fund founded by Mark Carhart, Bob Litterman, and Giorgio DeSantis, which is a pretty serious crew to be involved with. So anyway, I think this is a great conversation. I enjoyed it.
All right, let's go to our conversation with Professor Juhani Linnainmaa.
Juhani Linnainmaa, welcome to the Rational Reminder Podcast.
Thank you. It's great to be here.
All right. Yeah, we're super excited to be talking to you. Okay. So, Juhani, I want to start with financial advisors, which you've done a lot of really interesting work on. In the sample for your paper, The Misguided Beliefs of Financial Advisors, how do the trading patterns of advisors compare with the trading patterns of their clients?
Okay, so that's a good question. So other people had previously looked at the trading patterns of clients and advisor recommendations, and they had found that many of the things that clients do seem to be something that academics would be advising against. Things like they mostly invest in active funds, they chase returns, they tend to prefer more expensive funds, and they also under-diversify in their portfolios. So in our paper, we got access to data on the advisors' own portfolios, and we find that they do many of the same things. Their portfolios look almost the same as those of their clients, which was a bit of a surprise.
And how do their investment returns compare with their clients?
So given that they do very much the same things in the portfolios and hold the same investments, in terms of gross of fees, the performance is almost identical. But net of fees, there's a bit of a difference because effectively the advisors are paying some of the fees to themselves, like trailing commissions. They come back to their own pocket. So in terms of net returns, there would be a bit of a difference between the advisors and clients.
Right.
Yeah, okay, that's super interesting. So advisors are doing the same trades and similar trades in their own accounts as they are in their client accounts. They're earning similar gross returns, but advisors are doing a bit better because they're compensating themselves on the funds.
That's right. Of course, given they invest in like more expensive funds, the advisors could also improve their own performance by holding a little bit different portfolios.
The advisors invest in more expensive funds than the clients?
No, they invest in a similar expensiveness.
Right.
So they could also improve their own performance by investing in different ways.
Right. So they're both the advisors and clients are investing in like high fee funds.
That's right.
Yeah, that's incredible. How does the investing approach of advisors change after they leave the financial services industry?
Yeah, that's a great question. So one of the concerns we had with the study was that if you look at the advisors' portfolios, maybe the advisors are not really doing what they truly believe in. That maybe they only do something because they want to convince their clients to do the same. And so maybe in that case, only when they're actively advising people, they invest in kind of like bad ways, into expensive funds, chase returns, and so forth. And so after they leave the industry, given that they have no clients anymore, maybe they now start investing in a way that they truly believe in. But what we find in our data is that advisors keep on investing in the same way, even after they leave the industry. So there would be no motivation to be like, what would be like, faking the portfolios, doing something that they don't truly believe in.
Yeah, that part of the paper is so interesting. So because it's like what you said, advisors could be fooling their clients or selling their clients by saying, "Look, I'm doing the same thing as you," but then they clearly were not just doing that because they keep doing the same thing after they leave. Yeah,
that's right. And also, we didn't really expect to see much of a difference because the way we got the data, it's something that the clients wouldn't have access to. So it would only be that if the advisors self-disclose their portfolios, then the clients would see it. So there's not great motivation for the advisors to do something in their own portfolios that they didn't believe in because they probably don't think that many people are going to be having access to their holdings and trades.
Yeah, no, that's interesting.
What do your findings suggest about the cause of advisors recommending high-cost mutual funds and chasing performance?
Yeah, that's a good question. So broadly speaking, there have been two explanations for, I guess there has been one main explanation for why clients do what they do, and that has been about conflicts of interest, that people have been looking at the clients' portfolios alone, and they say that, well, given that they invest in very expensive funds, active funds with high fees, maybe they're doing it because the advisors tell them to buy those funds because of conflicts of interest. Typically, advisors get compensated more by selling them more expensive mutual funds. But it could also be, and that's the explanation that we explore, is that it could be coming from misguided beliefs, as we title the paper, that maybe the advisors are not telling the clients to do something because of conflicts of interest, that they get more compensation, but because they truly believe in that these are the right investments, in the sense that maybe the people who end up in this industry actually believe that markets are not that efficient, that it's pretty easy to beat the market. They are providing a service to the clients, they have higher returns, and as a compensation for the service that they provide, they're going to get some fee for that one. But of course, in the data, it doesn't work out that way. Typically, high fee funds are going to have lower returns, but the people who end up being advisors maybe predominantly don't know that. So again, it could be conflicts of interest, but our results seem to be more consistent with misguided beliefs, given that the advisors themselves are doing the same things.
Right.
Yeah, it's such an incredible finding because we ourselves talk about that all the time, that there's so many conflicts of interest, and particularly in Canada where so many of the mutual funds are sold on a commission basis. But your finding kind of suggests that maybe that's not the problem, or not the total problem.
Yeah, that's right. So it could also contribute to the issue. And undoubtedly, there are cases where people are just shamelessly exploiting the system that's in place. But it doesn't seem to explain the broad patterns in the data.
What do you think are the regulatory implications? Like if beliefs are such an issue, how can regulators be addressing it?
Oh, yeah, that's a really tough question. Anytime it comes to regulation, there's always a great temptation to just introduce more and more guardrails, because it should be pretty easy to say what's good and bad, but it gets out of hand pretty quickly. When you try to regulate anything, like we saw in the other study, there are always going to be some kind of unintended consequences. So in this study, we didn't take any stance on that one.
Yeah, okay. Well, we'll come back to that later, because your other study on that is also incredible. So at the client level, how do you think investors can assess the quality of a potential advisor's beliefs?
Yeah, that's also a good question. The problem is going to be that if you, as a client, you know to ask the right questions, that's already going to imply that you probably wouldn't even need a financial advisor. So of course, we want to advise people that when you look at an advisor, pay attention to the fees that you're going to be paying. Don't try to invest in funds that are going to be churning around too much and things like that. But again, if they can be asking those questions, that already implies that maybe they would know how to do it on their own. So somehow it would have to be about education, not just about how you approach the advisors, but how you tell people about the financial markets. And the issue that people have found, and this is not about our study, is that educating people about financial matters is really, really tricky. I think there was a study by Bruce Carlin from UCLA, where they looked at in a lab, they had people do experiment where they gave people different types of credit cards, different types of fees, and then they asked people to choose the best card, what would be the cheapest option for them. And of course, people made many mistakes with the choices, and then they educated people like what would be the right choice. And when they tested the people again, after the education session, they found that people make many fewer mistakes, that it's kind of easy to teach people to do the right thing. But then they did a follow-up where they asked the same people back to the lab a few weeks later and gave exactly the same test. And they found that none of the advice had stuck, that people again made the same mistakes. So we can always tell people that in terms of advisors, don't pay too much for mutual funds, don't chase returns, and probably they're going to be nodding and saying that makes perfect sense. But then when you meet with an advisor, they're going to be very convincing when they say that, well, this can be high fee fund, but the returns are going to be even higher. And all the education that you have given is probably going to go out the window. So it's, again, the main question of, well, how do you educate people how to make the choices? That's the big question. We don't have an answer to it.
Yeah, that's not an easy problem to solve.
Yeah.
Okay, so you've got another great paper on financial advisors. Does one size fit all? In the sample for that paper for retail financial advice, does one size fit all? Which client characteristics do you see advisors basing portfolio customizations on?
So in that paper, we have a pretty massive sample. So in terms of statistical significance, almost everything is going to be playing a role. But in terms of like economic magnitudes, which characteristics lead people to hold different portfolios? Something like, of course, stated risk tolerance would be very important. People who say that I'm willing to take lots of risk, not surprisingly, they're also going to be taking much more risk in their portfolios. And things like investment horizons. People who say that I'm going to be in this for the long run, they tend to take more equity risk in their portfolios. Many of the characteristics also play a role. But again, statistically, that's in statistical terms. In terms of economic magnitudes, things like risk tolerance and investment horizon and age are going to be the more important ones.
How does the evolution of advised portfolios over the client's life differ from a lifecycle fund?
Yeah, that's a good question. So if you were to look at only the effect of age, that you partition people based on like being 20, 25, 25, 30, and so forth, and you look at the marginal effect of that one, so you're holding everything else fixed, and you plot that out, it doesn't look that different from the target date fund, that people tend to ramp up the riskiness of their portfolios when they're like mid-40s, and then they take it down. And that's, broadly speaking, the same type of shape of the pattern that we see for the target date funds. But then if you zoom out, and you take into account all the characteristics at the same time, there's going to be so much variation in the portfolios coming from other sources that the age doesn't really mean much at all. It doesn't go like up and down. It's tiny variation when it's confounded by all these other differences in demographics and the portfolios that people hold.
How do the client portfolios vary with their labor income characteristics?
There wasn't that much of a difference in that one. Again, when we do the study, we look at the multivariate regressions. So we're asking, holding everything else constant, like age, wealth, education, and things like that. How much more or less do you take equity risk when your income increases? And in that case, I think we find that the amount of risk you take goes down a little bit when you increase labor income. But economically speaking, the effect is not that meaningful.
And how much of the variation in client portfolios is explained by client characteristics?
Okay, so when we put everything into the regression, so that's going to be like 25, 30 characteristics, and there can be some dummy variables on top of that, I think we get an R-square of something like 8%. So that would be kind of saying that there's going to be lots of variation in how much risk different people take in the portfolios, and you put all these characteristics in, and it turns out that you can explain about 8% of the total variation. So 92% of what's happening in the portfolios remains unexplained, even though you throw in all these demographics.
And I want to ask what explains the rest of the variation, but before that, the characteristics that you look at in the regression, in theory, like in economic theory, would you expect them to explain most of the variation in portfolios?
That's a different and much harder question.
Okay.
We are not taking a stance on what kind of portfolios people should be holding.
Okay.
People have been writing about papers about the lifecycle problem for a long, long time, but we just don't know what the optimal portfolio would look like how much you should be investing as a young person, as an old person. People often look at the data, they see something like the pattern that we see, that people closer to retirement take less equity risk and so forth, and then they change the modeling assumptions to kind of match the pattern in data. But people haven't done really the starting from the first principles, make the most reasonable model, and then solve that model and see what the advice would be. But I think it would make sense that labor income should be important, age should be important, and so forth. But we don't exactly know what the magnitudes for those effects should be.
Right. Yeah, I guess it would depend on asset class assumptions too. Anyway, so you find about 8% of the variation is explained by client characteristics. What explains the rest of the variation in portfolios?
Yeah, so that's the key point of our study. So we would kind of assume that even if we don't know how the demographics are going to be coming together to determine the portfolio, we think that when you go to an advisor, they're probably going to look at you and talk to you and figure out that these are going to be exactly the best portfolio for you. But in the data, it turns out that the most important determinant of what kind of portfolio you hold is who is your advisor. So when we throw into the regression, so-called advisor fixed effects, so we just control that these clients have the same advisor, these clients have the same advisor, the power of the model to explain variation goes up significantly. So we start from 8%, and throwing in the fixed effects is going to take that R-square, or the adjusted R-square, up to 26%. So much, much more information coming from just from the fact of who you have as an advisor, as opposed to all these demographics.
So how do we know that clients aren't self-selecting into advisors that match the portfolio that they're actually looking for?
Yeah, that's a great question. So that would be one of the big concerns here, that maybe the advisor is already telling you something about what the client looks like. Maybe all the young people are going to find a certain type of advisor. Maybe all the high net worth individuals are going to have different advice and so forth. So maybe adding the advisor fixed effect is kind of like controlling for some kind of latent characteristics of the clients. So what we do in our studies, we look at advisors who could quit the industry. And so you have an advisor with 20 clients, that advisor disappears from the data, and all the 20 clients get transferred to a different advisor. If the portfolios are tailored based on the characteristics of the clients, then we would expect that who you have as an advisor doesn't make that much of a difference. So even after you get transferred to a new advisor, the portfolios remain the same. But what we find is that when you get transferred to a new advisor, all of these clients' portfolios change at the same time. So it has to be coming from the advisor, not some kind of constant latent unobserved demographics.
Yeah, that's such a smart way to look at it. So if the clients were self-selecting to advisors that had portfolios that they liked, if their advisor left the industry, they would go and find a new advisor that had those same fixed effects. But instead, the portfolio changes to whatever the new advisor prefers.
Yeah, that's right.
Wow, that's such a smart way to test it, and such a interesting but kind of scary finding. What explains the variation in advisor recommendations?
That kind of brings us back to what we discussed before. So when we now take these fixed effects from the regression and try to understand, well, controlling for all the demographics of the clients, why does this advisor advise all the clients to hold risky portfolios or less risky portfolios? We can first try to understand that by the advisor's own demographics. And we do find that things like age is going to play a role. All the advisors tend to recommend their clients to hold risky portfolios, controlling for the client demographics. But the biggest determinant is going to be the advisor's own portfolio. Again, if we find that you just happen to have an advisor who's taking lots of equity risk in his or her own portfolio, then all the clients are going to be doing the same. And again, I should be emphasizing that this completely, in terms of identification, there's going to be randomness here. It's as if you take a client from an advisor who doesn't like equities. As a consequence, the client is going to be taking very little equity risk in their portfolios. And if you put them to an advisor randomly, who's taking more risk in their own portfolios, then that advisor seems to be telling the client that, well, you want to be taking lots of equity risk. And that's what happens. So who you have as an advisor, just by luck, plays a tremendous role.
That's crazy. I was Googling about something last night, and I came across this thing. I won't say what it was from because I don't want to upset anybody. But it was an educational seminar hosted by a respectable organization in Canada. And the seminar was about why the stock market is way too risky for most people in the long run, and they should instead be investing in GICs, which is like a CD in the States. And I was just like blown away, but you could totally see how a client going from one advisor to that advisor, the portfolio would change pretty significantly. But between the other paper we just talked about, so we know that advisors have misguided beliefs, and we know that advisor fixed effects are pretty important to the portfolios clients get. I don't really have a question, but that's kind of a disaster, isn't it?
Yeah, I agree with that one. The issue here is going to be that, we came in with the prior that the advisor is going to be looking at the clients individually and customizing the portfolios. Maybe the way they customize doesn't make sense, that it goes against economic theory, but at least they're trying to do something different for the clients. And so, like you said, the fact that they just give the same portfolio to all the clients is maybe a little bit troubling.
If not portfolio customization, what do you think explains the high cost of advice in your sample?
Unfortunately, that's one of the limitations of what we can say here. So we could be looking at the investment performance of the portfolios. So maybe it would be, even though you don't customize, you give them such great portfolios that the performance more than makes up for it. We do look at that one. We find that the client's portfolios underperformed all these other benchmarks. So they don't seem to be adding value in that dimension. But then the problem is going to be, and you always run into the same issue in household economics, that there are always other things that could be going on. That maybe there's a reason why the clients are paying so much in fees because they're getting some other services in return. Maybe the advisor advising in taxes, maybe they're advising in how much to consume, how much to save, and questions like that. And we can never quite quantify those in the data. Always when we try to account for some other value, and even if we find that advisors are not adding value in this dimension, it could be something else. So we pretty much just throw up our hands up in the air and say, it's not customization, it's not better performance, it could be something else, we just can't say.
Is that kind of like a revealed preference type thing? Like we know that people are paying these fees, so there must be something, we just don't know what it is?
Yeah, well, that would be the argument that, well, if we don't find it, then people can say that, well, you are just missing it. There's something more, but because obviously the clients are getting some value, they wouldn't be paying 2% per year or 3% per year if they didn't feel like it.
Incredible. Well, so between those last two papers that we just talked about, misguided beliefs and the lack of customization in portfolios, what do you think advisors and clients who are listening to this should do with the information?
That's, again, kind of the hard question, the one about how you educate people. Something that might be useful would be some kind of more transparency, not in the sense of having more disclosure of like something that people are never going to be reading, but it would be kind of nice for the clients to know what type of portfolios other clients with similar demographics are holding. just to see if the portfolio that they're getting recommended is going to be very, very different than what other people are being recommended. That wouldn't be solving the issue because, again, we don't know what the right portfolio would be for the person, but at least having some kind of benchmark that am I holding like really expensive things? Am I under diversifying compared to other people and so forth? And if your portfolio looks kind of weird compared to the rest of the population based on matched demographics, then maybe you want to be asking more questions. But again, more broadly, there's no perfect solution to it. But maybe transparency would be better than just regulation.
Okay, yeah. So I want to move on to regulation. How did adoption of the Mutual Fund Dealers Association, or the MFDA, in Canada affect the use of financial advice in Canada?
Okay, so the reason for the MFDA, the stated reason for the regulation was to, after the Great Recession, to kind of restore the faith in the financial system. That maybe people were afraid to participate in the financial markets because they didn't understand those markets, and they were concerned that there was rampant fraud going on. And so maybe if we have more rules, people have more trust in the system, and they're going to be more willing to use advisors. What happened in terms of this regulation was that when it was introduced, according to industry reports, you had lots of consolidation. The competition went down massively. And so effectively, the supply of advice went down. And so when we look at people in our sample, the use of advisors in those regions that were affected by the regulation first went down significantly.
Crazy.
How did it affect equity market participation?
Yes, so equity advisors have a huge effect on equity market participation. So maybe not surprisingly, that if you take away some of the advisors, you decrease the supply, people are not going to have the advisors. And if they don't have the advisors, they're not going to be participating in the markets. So it's kind of interesting, like it's clearly an unintended consequence of the regulation, because the whole point was to restore the faith, get people to use more advisors, and by using more advisors, participate more in the markets. But because of the decrease in the competition, decrease in supply of advice, it turns out that the participation went down because of the regulation.
Crazy. So how important is the role of financial advisors in getting households to take equity risk based on your findings?
Yes, we were kind of lucky that the MFDA regulation was rolled out in different provinces at different times. So we can use the staggered introduction of the regulation to try to estimate the causal effect of having an advisor on stock market participation. Again, the concern would be that maybe the decision to participate and the decision to have an advisor are going to be correlated, in which case the correlation might be overstating the impact of advisors on participation. But in our case, again, we can try to identify what is the causal effect of advisors. And if you look at whether you don't participate or participate in markets, and then you have the advisor or don't have an advisor, having an advisor is going to increase the probability of participating between 54 and 90 percentage points. So there's a massive difference coming from that one.
Wow.
Advisor, you're not going to be participating. If you have an advisor for exogenous reasons, you're going to be much more likely to participate. In terms of how much you invest in the market, like do you put 30% of your money into equities, that increases by about 30 percentage points in the sample. So you would go from 30 percentage points without an advisor to 60 with an advisor. So they are economically huge effects.
Wow.
Wild.
I should note there's kind of interesting thing over here. So I mentioned before that there's a concern about the correlation that maybe if people who would be participating in the markets anyway, they are more likely to get advisors. Then if you just look at
right,
you have an advisor, don't have an advisor, and you measure how likely to participate, that might just like be overstating the effect. But in the data, it turns out that the bias goes the other way around. It's telling us that the people who are less likely to participate when left there on their own are more likely to seek financial advice and then participate. So when you cut down the supply, you're really like, if we only care about equity market participation, you're hurting the neediest people the most, the ones who are not going to be participating without advisors.
That is crazy. So I just want to recap and collect my thoughts for a second. So the MFDA is created to increase trust in the financial system, which increases regulation on financial advisors. That's rolled out to provinces in Canada at different times, so you can kind of test the effect of what happened. It reduces the supply of advice, which causes people who would have been more likely to seek advice to have a much lower equity share in their portfolios because they needed the advice to get invested into equities.
Yeah, that's right.
Wow. That's crazy.
How does the benefit of increased equity share compare to the cost of advice?
Yeah. So now we are kind of at the same point as before when we spoke about, well, it's not customization, but the performance. What's going on here? One could say that, well, if advisors help get people to the stock market, there's going to be some benefit from that one, because there's going to be some equity risk premium, maybe 5%, 6% in terms of long-term estimates. And so if you're going to be investing 30% more in equities, if you're an advisor, and that's the right thing to do, then you're going to be getting more return on your portfolio. So if you have like 30% and you have like 5% equity premium, that would be a sizable increase in the performance of the portfolio. But that wouldn't be enough to offset the cost of these advisors in our sample alone, because the cost is going to be like 2 to 3 percentage points. So it has to be something more than just equity market participation that's going on here. That put differently, having advisors to just put them in the stock market to give people high returns, the return is not going to be high enough to cover the cost of the advice. So again, it could be some other benefits that people get from having the advisors. But in terms of direction, having people participate in equity markets is a good thing, setting aside the effects of how risky the portfolio is going to be.
Do you have any empirical research on what the other services that clients may be getting from advisors would be? Like, is it increasing their saving behavior? Do you have anything on that?
We don't have something where we could compare the not advised and advised people. We see in the sample of advised people, we see the extent to which they use some kind of automatic savings plans, which might be a good thing. But we don't have the same information for the unadvised people. So we haven't been able to look at it.
Okay. Now, the MFDA sample in Canada, we're very familiar with this because we're in Canada, is kind of notorious for mostly using high fee commission-based funds where like the conflicts of interest that we talked about are a problem. Based on your findings in this paper, is it reasonable to assume that financial advice that's using lower fee products is net beneficial by increasing equity exposure and whatever else, but not having the 3% fee?
Yeah, I think that sounds, broadly speaking, correct, in the sense that if you think about just investing in any mutual fund and you randomly pick one, if you pick one with the low fee, that's never going to be a terrible investment. Just like it's very hard to beat the market in terms of gross returns, it's very difficult to systematically lose to the market in gross returns. And so if the fee is kind of tiny, it's not a terrible mistake to make. So giving those mutual funds to people would be a pretty good idea. But that being said, it brings us back to the problem that we don't really know what's the right thing for people to do. How much risk you want to be taking in portfolios. But if we fix that one and we say that, well, you want to be allocating 60% of your money into equities, and then you just randomly pick some low fee funds into it, that's going to be a good thing. And also, if you have the low fees and you have the advisor, they are going to be helping with the level of participation, and that might be a good thing. But again, with the caveat that we don't know what the right number would be. Do people on average take 30% of risk in equities or 90%? What's the right number?
Right.
How does the duration of the relationship with a client affect the equity participation and equity share?
So the effect is going to be positive, that the more time you have known your advisor, the more you're going to be investing in equities. For example, when we partition people based on how much they invest in equities at the time they first found the advisor, and you look at people who had somewhere between 0 and 20%, that's going to be running up over 10 years. So at the end of 10 years, those people are going to be having about 30 percentage points more invested in equities at that time. So it's pretty massive effect in terms of economic magnitudes, going from 0 to 20 to having 30 percentage points more at the end. Of course, that's over 10 years.
That's still huge effect, though.
Yeah.
How did getting a new advisor before the financial crisis affect investors' ability to remain invested?
Okay, so there are two different effects that we were looking at. One of them would be exactly the kind of the mean effect. The longer you know how much more risk you're going to be taking in equities. The other one was about the sensitivity to bad returns. We know from like the mutual fund literature, we know from other studies that people, of course, become very fearful and call it quits when they have bad performance in their portfolios. And so we wanted to understand if knowing somebody, trusting somebody is going to be attenuating the return investment sensitivity, in the sense that if you have known somebody for a long time, maybe you are willing to go through these rough times without liquidating your portfolio. So going to your question, when we look at the financial crisis, when we look at people who enter the crisis with a brand new advisor because their old advisor quit the industry, and we look at people who go into the crisis with an advisor they have known for a long time, there's an 8 percentage points difference in coming out from the other side with your portfolio intact. So the people who have a new advisor are much more likely to just give up on the stock market during the financial crisis than those who have the trusted advisor.
So that's 8 percentage points measuring like the number of people that stuck with it?
Yes, that's right. So if the probability of quitting is like, let's say 10 percentage points for the people with a long-running advisor, it would be 18 percentage points probability of quitting for the people who have a brand new advisor.
That's amazing. So there's 2 effects. They're having more exposure to stocks in their portfolio and also are less likely to capitulate when the market crashes?
Yeah, that's right. And both of those effects would be consistent with the money doctors type of story. That again, these advisors are providing a valuable service. That there's somebody who's holding your hand and telling you that, okay, sometimes stocks go down. You don't want to give up on the stock market when the returns are poor. That in the long run, it's probably going to be a good investment.
Yeah, super, super interesting. Okay, so what do you think that those findings tell us about the role of financial advisors?
I'm sorry, you cut out for a moment for me. Can you repeat the question?
Yep. Yeah, you cut out a second ago too. I don't know. Zoom's having problems. Was that okay, Cameron? Did we miss anything?
Yeah, no, it was good. I'm sure we'll pick it up in the audio.
Okay, yeah, because Juhani, you cut out like for maybe a second. Anyway, what do you think these findings tell us about the role of financial advisors?
They tell us that financial advisors are really important in the markets, that they do seem to be serving a valuable role. The different question would be like, well, what do we do with this information? I guess the key lesson would be that the market for advice is just like any other market. And so we want to think carefully about the regulation of that market. We could be pretty heavy-handed. And like we discussed before, you could always say that there's going to be bad behavior, good behavior. And we want to have all these guardrails in place to ensure that people get the best possible service, so they get the benefits, but none of the downsides. But now we're again back at the issue that it's really hard to say ahead of time what proper level and type of regulation would be, because there's always going to be the unintended consequences. It could be cutting down the competition, as we discussed before, and that could be having effects that you didn't anticipate. But again, this study is highlighting one of the benefits of having an advisor. So you were asking before, well, if it's not about the customization, it's not about the performance of the portfolio compared to benchmark index, why do you use an advisor? And this would be a partial answer to that one. It would be saying that you have these people who are reluctant to invest in the stock market when left on their own. They are much more likely to be willing to take risk when they have an advisor. And that is a valuable service, something that we didn't quantify in the other papers.
Interesting. Really, really interesting. And the duration of the relationship matters. Is there any lesson or idea in there about clients like not jumping around between advisors?
That's a good question. It would be kind of interesting to look more deeply into that one. But then you would have to have data on that quantifies exactly why people are jumping around. It goes back to your revealed preference thing, that if we just see people jumping around a lot, maybe those people and the advisors they have been with are very like non-random. There's some kind of selection going on. But the question you're asking is an interesting one.
Right, but you're using duration of the relationship as a proxy for trust. But if a client doesn't trust an advisor, even if they've been with them for a long time, then that kind of makes the effect go away.
Yeah, it would be kind of ideal to have some kind of objective measure of trust besides the length of the relationship.
So I think you touched on this already, but I want to put a finer point on it. What do these findings tell us about the role of regulation?
Yeah, I'm always afraid that somebody's going to be listening who's very anti or pro regulation. So my first instinct is just to say that we don't really know. But what we do know from the other studies that we have done is that, again, regulation can have these bad outcomes that people don't anticipate. Even if you are really well-meaning and you think that, well, there's nothing bad in saying that we want to ban this and this and this behavior, and you're going to be charging more than this in fees and so forth, it might seem like a perfect thing to do. It's very sensible. But then people can be changing their behavior, people can change their recommendations, or people can be quitting the industry, and all kinds of less than ideal outcomes may happen. So I guess the point is to think about this more as a market And think about how you would be regulating the stock market. You don't want to just like ban good and bad stuff in one dimension and assume that that's going to be helping the outcomes. But yeah, that's just a long way of saying that we just don't know. I'll just be careful in regulation.
Yeah. Super interesting. I think Burke and Van Binsbergen had a paper on regulating charlatans or something like that, and it was like an equilibrium, and they found that even if there are charlatans, if you increase regulation, it can be a net negative to consumers. Something like that.
Yeah, that's right. It was about argument about the competition. So even if you had these bad people, if you put them in the market, they're going to be competing with the good people, and the good people had to be responding by lowering their fees, which is going to be a good outcome for the markets. If you restrict the market to be only the good people, then it's going to be less competition, and they can charge higher fees. So it's kind of interesting take on it, that charlatans can also have a positive effect because of the increased competition.
Yeah, it's crazy. Counterintuitive. Okay, so that segment on financial advisors was incredible. Your research on that is just awesome. So I'm glad we spent some time on that. But I want to move on to another area that you've done a lot of really interesting work, which is the cross section of returns. So you got this paper, The History of the Cross Section of the Returns, which is really cool. What did you find when you looked at accounting-based anomalies like profitability and investment in the pre-1963 period?
Okay, yeah. As a background to that question, when you specify the 1963, people might wonder like, why that number? Why not 62, 64? And that's really kind of like the key point of the paper. That when we look at any accounting-based anomalies like value or profitability, we often start the sample in 63 because S&P founded the Compustat in 1962. And so after that one, we can have comprehensive non-selected accounting information for companies. So that's when we can construct these trading rules and we can see what the performance looks like. So in this study with Michael Roberts from Wharton, we got access to Moody's manuals going back to early 20th century. And so now we can be looking at the performance of the same rules before 1963. And roughly speaking, whether we look at alphas, information ratios, things like that, we find that the efficacy of these accounting-based anomalies is about 50% of what they are in the in-sample period, the period that the original studies were looking at. So they're far less powerful in the history than what they are in the in-sample period.
I brought this paper up in a discussion recently, and a comment that I got was, well, we can't trust the quality of the data in that pre-sample period. But I think you touch on this in the paper. How did the data quality compare?
Yeah, we look at that extensively, and we look at other papers that have been using historical data for other purposes, and they identify different points in regulation that should guarantee that this data is going to be of high quality. And whether we go all the way back to like 1920s or whether we start in 1940s, the conclusion is going to be the same. So we are pretty convinced in the paper that this is not an issue with data quality.
Interesting.
And what do these findings suggest about the anomalies you looked at?
Yeah, so the motivation for this study was to kind of try to disentangle two effects. That when you look at something like, let's say, the value premium, and if you think that that's coming from mispricing, you might imagine that as soon as the thing has been discovered and people start trading on it, it's going to make markets more efficient and the value premium is going to go away. But there's also the other possibility that maybe the effect wasn't real in the beginning. And so people have been data mining, they have found something in the sample, and when you look at performances anomaly in the outer sample period, it's going to be weaker. So two potential effects are going on. Maybe it wasn't real to begin with, it was data mining, at least it was stronger because of data mining, or it could be about the actions of arbitrageurs, that something was real, it gets discovered, and people trade against that one. And if you only look at the original sample, and you look at the sample that accrues afterwards, so the outer sample period, you don't know really which one is going on. There's a great paper by McLean and Pontiff that tries to separate those effects. But what we do in this study is we try to look at the other end of the sample. So we are saying that if people didn't know about this in the original sample period, then they most certainly didn't know about that when you go back to 1920s and 1930s. So that's going to be a kind of clean test of the data mining hypothesis. And given that we find that the decline in the performance of these factors, when you go from the in-sample, either to the post-sample or the pre-sample is about the same, 50%, that is telling us that most of the attenuation that we see in the performance of these factors is coming from the fact that they were data mined to begin with, not so much that they were discovered and then arbitrageurs traded against them.
Well, that's crazy. So you're saying that profitability and investment are data mine factors? Is that the finding?
So for any one factor, it's kind of hard to say that, well, this is a real one, this isn't a real one. If you take like value premium as an example, value performed really well up until something like the 2007, 2008, but it has been in a drawdown since then. But given how noisy the returns are, even today, you're going to be rejecting that the mean return since 2007 has been equal to the average mean return before 2007, just because there's so much variation in returns. The benefit of our paper is that when we look at the large number of anomalies, you're going to have much more power to try to see if there has been break in the performance. But for any one thing, we cannot say that this was about data mining. We can just say about the average is that either 50% of the things that people have discovered are not real, or maybe all of them are real, but they're just inflated by a factor of 100%. In the sense that the performance decreased by 50% when you go out of sample.
Yeah, that's crazy stuff. That kind of made me think of the Fama and French's paper on the value premium. I think that's what you're referring to with value. If you look at their post out of sample period, post sample, they found that the value premium was gone in the post sample period, but they couldn't statistically prove that it was different from the in sample period, something like that.
Yeah, that's right. They had a paper about that. I think you had the title right. The value premium.
Yeah. Okay. So how would the post 1963? So we take that sample that everybody's familiar with. How would the mean variance efficient portfolio using the size value, the market size value, profitability, investment factors, the Fama French 5 factors, how would that mean variance efficient portfolio have performed if we ported it back and invested it in the pre-1963 sample?
Okay, so there are two things that we were trying to look at here. So if you have some kind of sample like 1963 to 2020, and we see in that data that you have some kind of factors that seem to be working, then the question would be, well, how do you optimally invest in these factors? Oftentimes, admittedly, people are pretty careless about how they overfit the data and how much they think that people could not have known ahead of time. So oftentimes people construct like ex post optimal portfolios. They look at what would have been the optimal investments in the market size, value, profitability, and investment to maximize the Sharpe ratio in the in-sample period. And then they kind of assume that people would have known to make that investment ahead of time. Even though, of course, in 1963, they wouldn't even know about the profitability, let alone know how exactly what the covariances are to create the optimal portfolio. But in the computation that you're referring to, we say, well, let's train this model of investment using all the post-1963 sample, and then let's port it to the pre-63 sample and see what the performance looks like. So obviously, by construction, in the modern data after 63, this would be a great investment. The Sharpe ratio in that portfolio would be about 1, which far exceeds the Sharpe for the market of 0.4 of the same time period. But if you do exactly the same training rule in the pre-sample, the performance is about the same as that of the market. So having these additional factors with those weights are not really adding any value.
Yeah, that's crazy. You talked about investment fees earlier. If you were paying whatever more for the mean variance optimal portfolio, you're that much worse off than the market.
Yeah.
Okay, so it's kind of hard to form optimal X anti portfolios using ex post data. Do you have any thoughts on how to think about the optimal ex ante mix of factors in a portfolio?
Yeah, I think people just need to be much more careful about the aspects of data mining and overfitting. And you definitely don't want to be creating any portfolio based on the full sample and assume that that's going to be the experience that you're going to be getting. So what we highlight with the computation would be the data mining aspect, that if you look at any set of factors, you probably want to be assuming that the alphas out of sample is going to be about 50% of what you saw in the in-sample period. And then when you compute the optimal portfolio, that's going to be a whole different discussion, because anytime you bring in the covariance matrix, you're making lots of assumptions about how the factors are going to be offsetting each other, how much benefits you get from that one. So you want to be pretty cautious. That being said, we are definitely not negative on the factor investing, because we do find that there's going to be lots of alpha remaining in the factor investing. It's just that you want to be quite cautious about this one. I believe it that in the same Fama French paper that you mentioned, they also point out that factors are really, really noisy, in the sense that we tend to think about the US stock market going up, up, and up. But if you look at the volatility of the stock market, it's not outside the realm of possibility that you would see a 20-year period in which you're going to be losing money by investing in stocks in nominal terms. just because it's very easy to get bad enough draws just by luck that offset the mean effect in data. The same is going to be true for all these factors. So even if the value premium is still there, it would have still been easy to see a drawdown like we have seen after the financial crisis. So again, we are not condemning or saying that factor investing doesn't make sense. We are just saying that you want to be kind of careful about it. You don't want to look at the in-sample evidence and say that this is the greatest thing ever. I want to put 500% of my portfolio with leverage into factors. You want to construct smart portfolios, and you have to have some patience with it.
Yeah, interesting. So you're not negative on factors, more negative on over optimizing. Like you wouldn't want to build a portfolio that's heavily tilted toward, I don't know, the investment factor because that one did well in the sample that we have. Is that kind of the idea?
Yeah, that's right.
Yeah, that's interesting. I mean, we use factor investing for client portfolios. We use funds from dimensional fund advisors, and they tilt toward all 5 of the factors that we're talking about. Is there any way to think about the optimal mix of, how much value and how far do you push on profitability and all that kind of stuff? Or is it just kind of a naive, you should have a bit of exposure to factors and that's good enough?
I think that kind of brings us into the kind of realm of statistical learning or machine learning.
Oh, wow.
But you want to be kind of careful about the how you train the models or the investment portfolios. That if you do something like in the in-sample period, you want to be splitting that in different folds and trying to see like how much I want to be tilting in different directions, not to overfit to the sample. So there are methods for doing it, but people want to be careful about it.
Okay. All right. I want to move on to a little bit more on the value premium. You've got an incredible paper on this too. What mechanisms can cause firms to move between growth and value?
Okay, so in the first part of this paper, the decomposing value paper, we kind of complete the statistical approach to asking where the value premium is coming from. So like you're saying, well, why is something a value firm? Why is something a growth firm? And I guess there would be 3 answers to it. You might be a value firm because you have always been a value firm, or you might become a value firm because your book value of equity went up a lot and your market value of equity didn't change. Or it could be that your book value of equity remained the same and your market value of equity fell. Again, we are not taking any stance here in terms of economics. We're just saying that just mechanically, statistically, it has to be one of those things that tells you that you're a value firm today or growth firm today. So change the book value of equity or the change in market value of equity or some kind of fixed characteristic of the company that you're looking at.
And how does the value premium decompose into firms that changed in size and firms that changed in book value of equity?
Yeah, so when we isolate that into those 3 components, that you have always been a value firm, or you become a value firm because you retain more earnings, or you become a value firm because the market value of equity goes down, it's really the last component that drives all of the value premium. That if you, instead of looking at the total book to market ratio of firms, if you only look at the change in market value of equity component of that ratio, you're going to be getting more of the premium with less risk.
That's so firms whose market value of equity declined, and that's how they became value firms. That's where most of the value premium is coming from. Is that right?
Yeah, that's right. And it's maybe not that surprising afterwards. If you think about the sequence of events and the history of the literature, there was the DuPont and Thaler paper in the mid-1980s about the long-term reversals. And that effect was discovered before the value premium. The idea that if you look at stock returns over the prior 5 years, maybe skipping over the most recent year because of momentum, you get significant returns on a strategy that buys losers and sells winners. That's the long-term reversals. Fama and French came up with their value premium, or the HML, in the early 1990s, and they found that there's correlation between these 2 things, that the reason you get the long-term reversals is that it's also a value strategy. We are saying something a little bit different because we are not really measuring the stock returns. We are looking at the market cap changes. And the market cap, of course, can be changing for many reasons, because you can have like, it's going to depend on the dividends. It's going to depend on mergers and so forth. That's going to affect the total market value of the company. But when you put all that stuff together, it's really the change in the market value component that drives the value premium. Not the book value of equity component doesn't really play a role.
And what does this finding mean for investors who are pursuing the value premium?
Again, I want to be kind of cautious because just like we discussed before, now there would be a great temptation that instead of investing with this rule, I'm going to invest 100% of my money with this rule. So being the most cautious, you could just say that simply statistically, if you have any predictor that seems to be predicting returns and you believe in it, and you can decompose that predictor in different ways, like in our case, there would be 3 components: the historical or the long-term average book to market, the change induced by the book value of equity, and the change induced by the market value of equity. If you use that as one predictor, it's probably going to be less powerful than if you decompose the predictor. Assuming that you have enough data to do so, you can definitely get some value out of that. Our results that are specific to the US, they seem to be telling us that you would have gotten more premium with less risk by using the market value of equity component than you would get by using the total book to market.
Incredible.
But I'm not making guarantees that finding is going to be in all instances and all companies and so forth.
Yeah. That's the thing with financial economics. I think there aren't many guarantees. What do your findings mean for the theoretical explanation of the value premium?
So what we did up to this point was kind of like look at the things just statistically and try to learn from the data if these 3 different components behave differently in terms of predicting returns. But the interesting question is the one that you are asking, well, what's the explanation for what gives you the value premium? And our answer is going to be kind of negative on that one. After the Fama-French paper, there was this cottage industry that started that was churning out explanations for the value premium. So all kinds of different papers that were looking at different components of consumption and things like that to understand, well, what is the risk that people see in value stocks to explain the high premium? The way these things work is that you have some kind of theory. The theory is suggesting that there's some kind of empirical factor that you can be constructing, and then that factor is going to be covering positively with the value factor. That would be explained that in this dimension, value is more risky. And kind of surprisingly, many of these theories seem to work. So even though they have very different explanations, they all seem to be explaining the riskiness of value. But if you think about what we are doing, we are splitting the value factor into 2 components. There's the good part, the one that gets the premium, and there's the bad part that doesn't get the premium. And it turns out that these models, the factors that they suggest, they do cover it with the value factor, but they cover it with the bad part of value factor, the one about the book value of equity or the persistent value component. They don't really cover it with that component that gives the value premium. So they cannot be explanations for why value stocks outperform growth stocks. They're grabbing onto the wrong component of the predictor.
Really, really interesting. Juhani, we are done our most of our questions. We have the one on how you define success in your life, but we're only at an hour minus the time that we were down. Can I ask like 1 or 2 questions about factor momentum?
Yeah, sure. I'll try to think about something.
All right, I'll think about it real quick, and I'll tell you what I'll ask. If I ask, what are the implications of your findings on factor momentum for momentum strategies? Does that make sense as a question?
Oh yeah, that would be good.
Okay, I'll ask that. All right, we've got one more question for you just to finish off on a topic that the geekiest segment of our podcast community was very excited about when your papers on this came out. So I hope they'll be happy that I'm asking you about it. What do your findings on factor momentum suggest about pursuing momentum as a strategy?
Okay, yeah, that's a great question. That's one of the key ideas of that paper. So if you think back to momentum, people often say that the momentum has to be behavioral effect, that there's no good reason why something like this would exist in the rational world. Of course, we can have theories for momentum that would make it risky and so forth, but people say that seems, at least some segment of the academic population said that seems kind of implausible. At the same time, people were pointing out that if you look at the data, momentum doesn't seem to be a free lunch. If you look at the stocks that are winners, those winners tend to be covering with other winners, and losers tend to be covering with other losers. So there has to be some kind of commonality to those. But people couldn't find the one factor that would be explaining that. So what we are saying in the paper is that the momentum actually resides in the factors themselves. You have a large number of factors, like you have the Fama-French 5-factor model, but you have many, many, many factors beyond that. Some of the factors may be like useless as unconditional investments, but when they have good performance, they keep on having good performance, and they have bad performance, they keep on having bad performance. So the mechanism that we have here is that if you have momentum in the underlying factors, and you have all these different stocks that load on these factors, then the momentum from the factors is going to be transmitting into the investor stocks. So when you look at a winning stock, it has to be, setting aside the idiosyncratic component, it has to be that it's loading positively on the factors with good past performance, and it has to be loading negatively on factors with bad past performance. So you're trading momentum, but when you trade the momentum in individual stocks, you're indirectly trading the momentum in the factors. But that kind of brings up the issue of why momentum is risky and what factor momentum tells us about momentum. Every time that you trade momentum, you're effectively making a different bet on the underlying factors in the economy. When you buy the winners, you're going to be buying a certain configuration of the underlying factors. And when you sell the losers, they're going to be having opposite loadings on those factors, and you're going to be making a bet on those factors. And so obviously, if you buy those winners, it's not surprising that all of them tend to be co-moving going forwards in time, and all the losers are going to be co-moving going forwards in time because they have the similar factor loadings. It's just that when you now go forward 1 year and you rebalance those portfolios, the loadings are going to be very different because different factors have different past performance and so forth. But underneath it all, there's going to be this factor structure that's driving the returns on the stocks and the stock momentum, and it's also driving the differences in covering structures of the stocks that we are trading.
Is momentum a separate factor then? Like, is it a standalone factor?
So in our study, when we look at something like the UMD, that's going to be the complete momentum factor using all the equities in the US. And then you try to explain or span that with the factor momentum constructed from the US equity factors, you find that there's no incremental value in the momentum, that you can capture all of the profits of the momentum factor by trading the momentum in the factors themselves. So our results indicate that there wouldn't be a separate momentum factor. To some extent, it's something that's kind of hard to prove. We are lucky that in our sample, the factor momentum that we get from known factors is powerful enough to span the momentum. But you could imagine that if we didn't know about all these factors, that we were back in the 1970s and we had only 1 or 2 factors, the momentum in known factors wouldn't be probably enough to span the momentum that we see in stock returns. Because when you buy winners, you are buying factor momentum in all the factors that are out there, the known and unknown. So it's not easy to show that factor momentum spans momentum because we can only construct factor momentum in the factors that we know.
Yeah, that's super interesting. So what are the investment, like what are the portfolio management implications of factor momentum spanning momentum?
At least it's something about rethinking about how you trade momentum, that you can always trade the momentum in the underlying assets. If you think that that's going to be profitable net of trading costs, it should also be strictly better to do it that in the factor space. Because there might be better ways of trading like portfolio stocks than trading the individual stocks and trading the factors. So it should be helping you construct better portfolios if you're leaning towards momentum.
Super interesting. Awesome.
Good for our last question, Ben?
Yep.
All right, Professor, how do you define success in your life?
Yeah, I was thinking about that one. I think I only have platitudes for you in the sense that for me, it has been mostly about minimizing regret. That it's kind of hard to know ahead of time, like what do you want to be doing and where you might find success and what you can be good at. But I always think about I want to be doing more stuff. I want to try all kinds of new things because that's the only way that you can actually find something that's going to be interesting. And you cannot really like maximize your success ahead of time because you don't know what's out there. But if you grab at every opportunity and try to do all kinds of things, it's going to be more fulfilling in the sense that I don't think we are ever going to be regretting things that we tried and it didn't work out for us. But we are going to be regretting that 10 years ago we didn't do something. We had the opportunity to do something, but we didn't take that opportunity. And then we think that, well, what might have happened? So as I get older and older, I'm painfully aware of that one, that I always think about, well, I must try to do more and more, both in like work and life, so that I'm not going to grow up with the regrets that, well, I should have done that thing over here. And also that's, I guess, kind of specific to academia, that there are many of these people who have been super successful. They have done some really important work, but as they get older, they tend to be doing what comes easy to them. They keep on doing variations of the research that they did before. And then they are 60s, 70s, 80s, and they kind of do the same stuff. And that might make them happy, but I'm kind of fearful that that's where I'm going to be ending up. So that's every single day. That's why every single day I try to do something different.
Wow.
Great
Really
answer.
interesting.
Yeah, really cool answer. All right, Juhani, this has been an excellent conversation. We really appreciate you joining us on the podcast.
Oh, thank you. This was great.
Yeah, great to meet you. Thanks for joining us.
Thanks.